Every trader hunts for complex strategies, indicators, and secret formulas, believing sophistication creates profit. The truth is uncomfortable. Consistency is built on one simple rule most traders ignore. Not because it's hard to understand, but because it demands discipline, patience, and execution without negotiation, trade after trade, regardless of outcomes. Most traders don't overcomplicate trading because they're careless or undisciplined. They overcomplicate it because they're trying to feel safe. In the beginning, complexity feels like protection. The more indicators on the screen, the more rules in the strategy, the more conditions that need to line up, the safer it feels. Complexity creates the illusion of control. It makes you believe that if you just analyze enough, filter enough, and adjust enough, you can eliminate uncertainty. And because trading is uncertain by nature, human brain naturally gravitates toward anything that promises clarity. That's why so many traders believe complexity equals edge. They assume that if a strategy is simple, be weak, and if it's complex, it must be sophisticated. But the market doesn't reward sophistication. It rewards execution. And execution becomes harder, not easier. Complexity increases. This belief is reinforced by how trading education is marketed. Strategies are packaged with layers of indicators, advanced terminology, and endless variations. It makes the learner feel like they're gaining depth, like they're accessing something exclusive. But what's really happening is information overload. Instead of learning how to execute well, traders get trapped in learning how to analyze endlessly. Every loss is blamed on a missing filter. Every drawdown becomes a reason to tweak the system. Over time, the trader becomes addicted to modification. They change time, frames, adjust indicators, add confirmations, remove confirmations, then add them back again. It feels productive, but it's not progress. It's avoidance. As long as you're tweaking, you don't have to sit with the discomfort of uncertainty or the responsibility of execution. You can always tell yourself, I just need one more adjustment. The real damage of over-complication shows up in execution. When a setup finally appears, the trader hesitates. Too many rules are firing at once. One indicator agrees, another doesn't. A condition is almost met, but not perfectly. The moment passes while the trader debates with themselves. Or worse, they enter late, exit early, or manage the trade emotionally because they don't fully trust what they're doing. Confidence erodes because the trader never knows if the loss came from the market or from their own indecision. Overthinking turns trading into a mental tug-of-war where every decision feels heavy. And when decisions feel heavy, mistakes multiply. Missed trades, impulsive entries, early exits, all symptoms of a mind that's overloaded. Simplicity feels uncomfortable because it removes the illusion of protection. When you simplify, you're forced to accept that no amount of indicators can remove uncertainty. You're forced to rely on a small set of rules, and your ability to follow them consistently feels risky, especially for traders who equate effort with safety. But simplicity is not about doing less work. It's about doing the right work. Simple systems work not because they predict the market better, but because they allow the trader to execute better. With fewer variables, decisions become clearer. Clearer decisions, confidence grows. And with confidence, consistency becomes possible. Most traders don't realize is that professional level trading often looks boring. Clean charts, repetitive setups, minimal adjustments. Edge doesn't come from complexity, it comes from mastery of the basics. The market doesn't reward creativity in analysis, it rewards discipline in execution. The traders who last aren't the ones constantly reinventing their approach. They're the ones who found something simple, tested it, and then committed to executing it through wins, losses, and drawdowns. They understand that consistency is built through repetition, not innovation. Overcomplication also feeds the ego. It allows traders to feel intelligent even when results are poor. Easier to say, the strategy needs refinement, than to admit, I didn't follow my rules. Complexity gives you something external to blame. Simplicity removes that escape. When your system is simple, every mistake is visible. Every rule break is obvious. That level of accountability is uncomfortable, but it's also powerful, where real growth begins. The uncomfortable truth is that trading becomes easier only when you stop trying to make it easy. The more you chase certainty through complexity, the more confused you become. The moment you accept uncertainty and build a simple, repeatable process around it, the pressure starts to ease. Stop fighting the market and start working with it. You stop trying to outsmart it and start managing yourself. And that's the shift that changes everything. When traders finally simplify, they often feel exposed at first, like they're missing something, like they're not doing enough. But over time, something unexpected happens. Execution improves, stress decreases, confidence stabilizes. Results become more consistent, not because the market changed, but because the trader did. He stopped hiding behind complexity and started taking responsibility for execution. If you've been adding more and more to your trading, hoping the next indicator or strategy will finally make things click, it might be time to pause and ask a harder question. What if the problem isn't that trading is too simple, but that you've been making it harder than it needs to be? Because the moment you realize that, you stop searching for more and start focusing on better. Most traders hear this rule and immediately think they already follow it. Execute your plan exactly as written every time. It sounds almost too obvious to matter. Of course you should follow your plan. That's trading 101. And yet this single rule is where nearly all inconsistency is born. Not because traders don't understand it, because they don't respect it. Knowing a rule and living by it under pressure are two very different things. The market doesn't punish a lack of knowledge nearly as much as it punishes small lapses in commitment. And those lapses usually happen quietly, in moments that feel justified at the time. The reason this rule changes everything is because it removes interpretation from execution. When you truly execute your plan exactly as written, there is no room for improvisation based on emotion, fear, or recent outcomes. Most traders think their problem is strategy, but their real problem is flexibility where there should be none. They follow the plan when it feels comfortable and bend it when it feels risky. Skip trades because they don't like the look of it, even though it meets all the criteria. Or they take trades that almost fit the plan because they don't want to miss out. These are small violations, but over time, they quietly destroy consistency. Edge isn't designed to survive selective execution. It only works when applied fully, across a large enough sample, without interference. Is where the difference between knowing a rule and respecting it becomes clear. Knowing the rule is intellectual. Respecting it is behavioral. You can explain your plan perfectly and still sabotage it in real time. Respecting the rule means you follow it even when the last trade was a loss, even when you're on a losing streak, even when the setup feels uncomfortable. It means you accept that the plan's job is not to make you feel good, to give you a positive expectancy over time. The moment you override the plan to protect your emotions, you're no longer trading the system, you're trading yourself. Small violations are especially dangerous because they don't feel like mistakes. They feel reasonable, this once. Taking partial profits early to be safe. Skipping a valid setup because you're frustrated. Each decision feels minor in isolation, but together they rewrite your system into something untested and unreliable. You end up with results that don't reflect your strategy's true edge, and that creates confusion. You don't know whether the system works because you've never actually followed it cleanly. Over time, confidence erodes, not because the plan is bad, but because you've trained yourself to not trust it. Executing the plan exactly as written also shifts responsibility in a powerful way. When you follow the rule, stop being personal. A losing trade is no longer a failure of judgment, it's simply one data point in a larger process. Removes a huge amount of emotional weight from trading. You stop trying to be right on every trade and start trying to be consistent in your behavior. And consistency of behavior is the only thing that produces consistency in results. Without this rule, everything else, risk management, psychology, discipline, stays theoretical. The uncomfortable truth is that most traders aren't missing knowledge. They're missing commitment. They don't need another indicator, another strategy, or another course. They need the willingness to execute what they already know without negotiation. This rule exposes that gap brutally, which is why it's so often ignored. It forces you to confront your habits, your impulses, and your relationship with uncertainty. But if you can commit to this one rule, fully and honestly, it becomes the foundation that everything else rests on. Because once you stop bending the rules, the market finally shows you what your edge actually looks like. Most traders don't break the rule because they don't believe in it. They break it because, in the moment, breaking it feels like the smarter choice. That's what makes this stage so deceptive. Interference doesn't show up as recklessness, it shows up as adjustment. You're mid-trade, watching price move against you, and your brain starts offering solutions. Move the stop a little. Take partials early. Close the trade and re-enter later. None of these feel emotional in the moment, feel analytical. They feel like experience talking. But what's really happening is that uncertainty has triggered discomfort, and your mind is trying to regain control. Instead of letting the plan play out, you intervene to relieve that discomfort. And every time you do, You weaken the very thing you're trying to build trust in your process. Is why so many traders interfere mid-trade to improve results. The trade hasn't failed yet, but it doesn't feel good, and that's enough. The brain confuses emotional relief with smart decision-making. The irony is that these small interventions almost never improve long-term performance. They only improve short-term comfort. Over time, you train yourself to believe that the plan is optional, something to follow until it becomes uncomfortable. And once that belief takes hold, consistency becomes impossible. You're no longer trading a system, you're trading your emotional state in real time. Wins and losses make this even worse. After a win, confidence spikes. You feel sharper, more in sync with the market. Rules start to feel flexible because you're seeing things clearly. You take trades a little earlier, size up slightly, or ignore a condition because you trust your intuition. The opposite happens. Fear creeps in, you hesitate, you skip valid setups. Or you tighten stops, cut winners early, and second-guess every decision. In both cases, the market hasn't changed. Your plan hasn't changed. But your behavior has. Recent outcomes start influencing decisions that are supposed to be independent of them. Is one of the fastest ways traders sabotage themselves, because it feels responsive and adaptive, when in reality it's reactive. What makes this especially dangerous is how emotional decision-making disguises itself as analysis. Traders rarely say, "I'm scared." They say, "Structure doesn't look as clean." They don't say, "I'm chasing." They say, "Momentum is strong." The language sounds logical, but the timing tells the truth. Decision wasn't made during planning, it was made under pressure. Analysis done before the trade is structure. Analysis done during emotional arousal is justification. And once you start justifying instead of executing, the rule is already broken. This is why discipline alone is not enough. Traders believe their issue is emotional control, so they try to be more disciplined. They rely on motivation, willpower, or self-talk to stay in line. But discipline without structure always fails. Willpower is finite, emotion is not. If your process leaves room for interpretation, emotion will fill that gap every time. Fixed process doesn't ask how you feel. It doesn't care about your last trade. It doesn't respond to anxiety or excitement. It simply tells you what to do and when. Without that rigidity, discipline turns into a daily negotiation, and negotiations are always influenced by emotion. This is the key realization most traders miss. The problem isn't that you have emotions. The problem is that your process isn't fixed enough to protect you from them. Emotions are part of the system. They're predictable. They show up in the same places over and over again, after losses, during drawdowns, when price moves quickly, when you're close to break even. Strong process anticipates this and removes decision-making from those moments. A weak process leaves room for judgment, and judgment under pressure is just emotion with a smarter name. When traders finally see this, something clicks. Trying to eliminate emotion and start trying to eliminate ambiguity. They stop asking, "How do I stay calm?" and start asking, "Where does my process allow me to interfere?" That shift changes everything, because once the rules are truly fixed, execution becomes simpler. Not easier, but simpler. You either followed the plan or you didn't. There's no gray area, and in that clarity, confidence starts to rebuild. Breaking the rule isn't a moral failure, a structural one. Traders don't need to become emotionless robots. They need a process that doesn't depend on emotion behaving itself. Once you understand that, struggle stops being personal. You're not weak. You're not undisciplined. You're operating with a system that leaves too much room for interference. Fix the structure, and discipline follows naturally. And that's the moment most traders realize the truth. Their problem was never emotion, but the absence of a fixed process strong enough to contain it. When you truly follow one rule, execute your plan exactly as written, every time, everything in your trading begins to reorganize itself around that commitment. Not overnight, not dramatically, but structurally, is where most traders misunderstand transformation. They expect a sudden jump in profits, a feeling of certainty, or a streak of wins that proves the rule is working. What actually changes first is far more subtle, and far more important: your execution stabilizes. And once execution stabilizes, everything else finally has a chance to work the way it was always supposed to. The first noticeable shift is in your decision-making. Before this rule is respected, every trade feels like a fresh problem to solve. You analyze, hesitate, re-analyze, doubt, confirm, and sometimes still act against your better judgment. Making is noisy and exhausting because it's happening in real time under pressure. Once you commit to executing the plan exactly as written, that noise starts to fade. Decisions move upstream. They happen during planning, not during the trade. By the time the setup appears, the decision has already been made. Either it meets the criteria or it doesn't. There's no debate. This removes a massive cognitive load that most traders don't even realize they're carrying. You stop burning mental energy on choices that should have already been settled. With stabilized decision-making comes stabilized execution. You enter where you said you would. You place the stop where the plan dictates. You take profit according to rules, not feelings. This doesn't mean trades suddenly feel comfortable. They don't. Uncertainty is still there. Losses still happen. But your behavior becomes consistent even when your emotions are not. That consistency is everything. It means that for the first time, your results actually reflect your strategy instead of your mood. You're no longer mixing a sound system with random execution. Finally, testing one thing cleanly. As execution stabilizes, overtrading naturally decreases. Overtrading is rarely about greed alone, it's often about ambiguity. When rules are flexible, there's always a reason to take another trade. It's close enough. This one looks strong. I'll just take a small position. But when your plan is fixed and execution is non-negotiable, those justifications lose their power. If the setup isn't there, you don't trade. Not because you're forcing discipline, but because there's nothing to do. The rule makes inactivity acceptable. It reframes waiting as part of the job, not a failure to act. Alone saves traders from countless unnecessary losses that never should have existed. At the same time, hesitation starts to disappear. Before, hesitation came from internal conflict. Part of you wanted to follow the plan, another part wanted certainty. That conflict creates delay, missed entries, and second, guessing. When the rule is absolute, the conflict dissolves. You don't hesitate because there's nothing to decide. The signal appears, you execute. If it doesn't appear, you wait. Hesitation is replaced by clarity, and clarity, over time, creates calm. This is where traders begin to understand consistency through probabilities rather than predictions. Inconsistency comes from treating each trade like a prediction that must be right. When you follow one rule relentlessly, mindset shifts from "this trade needs to work" to "this trade is one event in a large series." You stop trying to predict outcomes and start participating in an edge. Losses no longer shock you because they were always accounted for. Wins don't excite you excessively because they were never the point. The only thing that matters is whether you executed correctly. This probabilistic thinking is impossible without strict rule adherence. You can't think in probabilities if you keep interfering with individual outcomes. Over time, something important happens. Your emotional reactions start to soften, not because you've mastered emotion, but because repetition under structure retrains your nervous system. When you do the same thing over and over in uncertain conditions and survive, your brain learns that uncertainty is not a threat. Losses stop feeling like emergencies. Downs stop feeling like identity crises. You recover faster. You stay more neutral. This is not emotional control through effort. It's emotional adaptation through exposure. And that exposure only works when your behavior is consistent. Confidence begins to grow here, but not in the way most traders expect. It doesn't come from winning streaks. It comes from self-trust. You start trusting that you will do what you said you would do, regardless of how you feel. That trust is rare and powerful. It changes how you show up to the market. You're no longer trying to prove anything. You're executing a job. And when confidence is built this way, it doesn't disappear after a bad week. It's grounded in identity, not outcomes. Another quiet shift happens in how you review your trades. If obsessing over PL, you review behavior. Did I follow the rule? Did I execute exactly as written? If yes, the trade is a success regardless of outcome. If no, is on execution, not the market. This clarity accelerates learning. You stop making emotional adjustments and start making structural ones. You refine rules slowly, intentionally, and based on data, not frustration. This is how systems actually improve. Consistency, at this point, stops being something you chase and starts being something that emerges. You're no longer trying to be consistent. You're being disciplined, and consistency becomes the byproduct. Your equity curve may still fluctuate, but it does so within a structure you understand. The chaos is reduced. The swings are survivable. You stay in the game. And staying in the game is the prerequisite for everything else. This is why one rule changes everything. Not because it guarantees profits, it creates the conditions under which profits are possible. Without it, nothing sticks. With it, everything compounds. Discipline compounds. Experience compounds. Pattern recognition compounds. Emotional resilience compounds. And one day, often without realizing when it happened, you look back and see that you've crossed a line. Trading no longer feels like a constant internal battle. It feels like a process you can trust. The final realization is simple but profound. Consistency was never something you needed to force. It was something you needed to allow. And the way you allow it is by removing negotiation from execution. When you follow one rule fully, the market finally meets you halfway, not by being kind, but by being predictable in its unpredictability. And that's all a trader ever really needs. Consistency is not the reward for discipline. Consistency is the by-product of discipline. Turning a rule into a non-negotiable habit is where trading stops being something you try to do and starts becoming something you are. Up to this point, the rule, execute your plan exactly as written, every time, may have made sense intellectually. You may even have followed it for stretches, but long-term profitability doesn't come from understanding the rule or occasionally applying it. It comes from embedding it so deeply into your behavior that breaking it feels unnatural. This is the final transformation most traders never reach, not because it's complicated, but because it requires a shift in identity, not effort. The first step is writing the rule clearly and removing flexibility. Traders believe they have rules, but what they actually have are guidelines. They leave space for interpretation, judgment, and emotion. Ideally, most of the time, or, if it looks good, are silent killers of consistency. A rule that can be bent is not a rule, it's a suggestion. Suggestions don't survive pressure. To make execution non-negotiable, the rule must be explicit, simple, and binary. Either you followed it, or you didn't. There'd be no room to argue after the fact. This means your trading plan must be written in a way that removes choice during execution. Entry criteria should be precise. Parameters should be fixed. Exit rules should be predefined. Not because this guarantees better results on every trade, but because it guarantees consistent behavior. And consistent behavior is the only thing that allows probabilities to work over time. Flexibility feels mature, but in trading, flexibility during execution is just delayed emotion. Professional traders are flexible in design, rigid in execution. They review and adjust rules outside market hours based on data. But when the market is open, the rules are final. Once the rule is written clearly, the next transformation is how you measure success. Most traders measure profit because it feels objective and motivating. But profit is a lagging indicator. It reflects many things you cannot control in the short term. Measuring yourself by profit during the habit-building phase is like judging physical fitness. By looking at the scale after every workout, it creates emotional noise and encourages shortcuts. If you want the rule to become a habit, you must shift your measurement from profit to execution. Measuring execution means asking different questions. Did I take only valid setups? Did I respect my risk limits? Did I execute entries and exits exactly as planned? I avoid interference mid-trade. These are the metrics that matter now. You can have a losing day and still score perfectly on execution, and that matters more than a winning day with rule violations. When you consistently reward yourself for correct behavior instead of outcomes, your brain begins to associate discipline with success. This is how habits are formed. You're rewiring what winning means at a neurological level. Also changes how you experience losses. Losses stop feeling like personal failures and start feeling like routine costs. You expected them. You planned for them. They no longer demand emotional explanations. And because they're no longer threatening your identity, you don't feel the urge to interfere or fix them in real time. Emotional neutrality is not something you force, it's something that emerges naturally when execution becomes the primary goal. Where this habit either solidifies or collapses, most traders review trades to judge outcomes. They ask, was this a good trade? And that question is useless for building discipline. A better question is, did I execute the rule? Outcome-based reviews reinforce emotional thinking. Discipline-based reviews reinforce professional thinking. When you review trades for discipline, your focus shifts to behavior patterns, noticing where you tend to break rules after losses, during boredom, near session highs, when price moves fast. These patterns are gold. They tell you exactly where your process needs tightening. A proper review doesn't shame you for mistakes. It documents them. It treats errors as system feedback, not character flaws. If you broke a rule, the question isn't, why am I like this? It's, what allowed this to happen? Was the rule unclear? Was the environment distracting? Risk too high for your emotional tolerance? Each answer leads to a structural fix, not a motivational speech. This is how professionals operate. They don't rely on willpower, they engineer environments where discipline is easier than indiscipline. Over time, as execution becomes habitual, something subtle but powerful happens. Your identity starts to change. You stop seeing yourself as someone trying to become consistent and start seeing yourself as someone who follows rules. This identity shift is critical. Behavior that aligns with identity requires less effort. When you identify as a disciplined trader, breaking rules feels like acting out of character. And acting out of character creates discomfort. That discomfort becomes your internal stop-loss. You don't need external motivation to follow the rule anymore. Your sense of self enforces it. Building a professional trading identity also changes how you relate to the market. You stop looking to it for validation. You're no longer asking it to make you feel smart, capable, or worthy. Your worth is tied to your professionalism, not your P&L. Frees you from emotional dependence on outcomes. You can have a losing month and still feel solid because you know you operated correctly. That stability is rare, why professionals last. Another important shift is that you stop chasing better strategies. This is one of the clearest signs that the habit has taken hold. Strategy hopping is often disguised as curiosity or improvement, but it's usually avoidance. It's easier to believe the problem is the system than to confront inconsistent execution. Once the rule becomes non-negotiable, that excuse disappears. You realize that most strategies work when executed consistently and most fail when they're not. The edge was never missing, it was being diluted by interference. Doesn't mean you never improve your strategy. It means improvement becomes deliberate and slow. You change one variable at a time. You test it over a meaningful sample to execution. There's no urgency, no desperation. You're no longer trying to escape discomfort by changing systems. You're building depth instead of chasing novelty, where real edges lie. As months pass, the compounding effect becomes visible, not just in your equity curve, but in your mindset. Trading becomes calmer, feels shorter. Losses feel smaller, wins feel quieter. You're less reactive, less impulsive, less attached. You start seeing the market more clearly because your emotions aren't constantly distorting perception. This clarity doesn't come from intelligence, it comes from discipline repeated so often that it becomes automatic. Long-term profitability is rarely explosive. It's gradual, stable, and almost boring, exactly why so few reach it. Boredom doesn't feed the ego. Discipline doesn't feel heroic. Following one simple rule every day doesn't make for exciting stories. It works because markets reward consistency, not intensity. They reward survival, not brilliance. They reward those who can show up the same way tomorrow, regardless of what happened today. The final transformation is not becoming a trader who wins more often. Becoming a trader who behaves the same way regardless of outcome. That is what creates long-term profitability. When execution is non-negotiable, results take care of themselves over time. You stop chasing better strategies and start executing one simple rule consistently. And in that simplicity, you find what most traders never do: stability, confidence, and sustainability. At that point, trading stops feeling like a constant struggle. It becomes a profession, a process, a craft. And the rule that once felt restrictive becomes the thing that gives you freedom.